Hello and welcome back to the beach. Today what we're looking at are variances again, and this time it's sales variances. Now when we're looking at sales variances, there are two main variances you need to have an awareness of. You need to have an awareness of a price variance, which comes about because actual price may be different from your budgeted price, and then a volume variance because the volume of sales, the number of units you sell, that you actually sell may be different from the budgeted number of units you expected to sell. So your actual volume is different from your expected or your budgeted volume. And once again, we've got some standard pro formas. You can just simply learn parrot fashion and just slot numbers in as you see fit. So what we have is the sales price variance first, then we'll look at the sales volume variance. Now my sales price variance looks at the difference. So it looks at the difference between actual sales at actual price and then actual sales at standard price. The difference there is price, therefore this becomes my price variance. This will tend to be called a sales price variance. So be careful with this, please, guys. I haven't put sales in here, but be aware that this is definitely a sales price variance. What this does, if this is a favorable variance, it means that we've sold the units at greater than the budgeted price, which means that the figure at the top is higher. Remember this, please, guys. This is a revenue-based variance. So we want the numbers at the top to be bigger now. It's not the same as all our cost variances, where we want the numbers at the top to be smaller because we want our actual cost to be lower. But now it's sales revenue. I want my actual sales revenue to be higher than my expectations, than my budgeted figures. The sales volume variance shows the impact on profits. So it shows the impact on profits by selling more units. And what we have is actual sales multiplied by standard contribution or standard profit. And then we compare that with budgeted sales multiplied by standard contribution or profit. There's lots of things to point out here, please, guys. So just pay attention very, very quickly. Standard contribution or profit, which one should we use? It depends upon the type of costing mechanism that you have. If you're using a marginal costing system, I use standard contribution, which will come straight from the standard cost card. If I'm using a full or absorption costing system, I will use the profit figure at the bottom, which again will come from the standard cost card. So both of these figures will come from the standard cost card. The way the standard cost card is drafted up will give you a huge clue as to whether you should use contribution or profit. If there's an OAR in there, then you've got to use profit. Okay, so if there's an OAR in there, you've got to use profit. The other thing to bear in mind here, guys, when I look at budgeted sales multiplied by standard contribution or profit, that's the original budgeted sales. There is no flexing here. So that's the original budgeted sales. So be very, very careful with that. And what this sales volume variance does is actually shows you the impact on my profit, the impact on my bottom line based on me selling more units. So it shows me the impact on my bottom line by me selling more units. Now let's have a look at an example and see how this comes about, because we're going to have to do this in two different parts. We've got to do the sales price variance separately from the sales volume variance. So the example we've got, budgeted sales are 10,000 units, actual sales are 11,000. So we've sold more units than we would have normally expected. That means I'm going to have a favorable volume variance because I've sold more units, because actual sales are bigger than budgeted sales. So that's going to give me a favorable volume variance. When I look at the sales price, budgeted sales price is $12, actual sales price is only $10. That now means that my sales price variance is going to be adverse because my actual sales price is below the budgeted sales price. And you can sort of see here what's happening. We've sold more units, but to sell more units, we've had to drop the price. So you can actually have a tie in here to some sort of price elasticity of demand issue. So selling more units, I've had to drop the price. Sales price variance is the one I'm going to calculate first, and I need to work out the difference in those prices. And once I've worked out the difference in the prices, then I can start multiplying it through by the actual sales, and there's my actual sales as well. To work out my sales volume variance, I've got the difference in sales between the 11,000 units and 10,000 units, and I've now got a profit per unit, which is given to me in the question as being $4. So that comes straight from the standard cost card. My sales price variance will be actual sales at actual price, and I'm going to compare that with actual sales at standard price. So if you think about the way the numbers tie in here, actual sales were 11,000 units, actual price is only $10 per unit. That gives me a total revenue of $110,000. What then happens is actual sales of 11,000 multiplied by the standard price of 12 gives me 132,000. That gives me an adverse price variance. But we knew it was going to be adverse because we've sold these things at $10 instead of the $12 we thought we could sell them for. So there's the difference. So there's a big, big difference. The second variance we have is our sales volume variance. And with this sales volume variance, what I'm looking at is actual sales at standard profit. And I'm going to compare that with original budgeted sales at standard profit. So if we take this pro forma, slot some numbers in, we get actual sales of 11,000 units multiplied by $4, which is my standard profit, which gives me 44,000. We then have original budgeted sales of 10,000 units at $4 profit, gives me 40,000. That now gives me a sales volume variance, which is going to be favorable again. So we've got a favorable volume variance. So we have a favorable volume variance, but here we had an adverse price variance. And those two things will be linked together. Okay. Now, hopefully all of that makes sense. Do make sure you're happy with the way the pro formas work again here, guys. It's the easiest way to make sure you understand how this type of thing works. If you do need some additional support, we are still there. We do lots of stuff on YouTube. There's lots of little 5 and 10 minute broadcasts on YouTube. And we also have our website, ipalearning.com. And if you want to go on there, there's lots of free courses and there's lots of additional courses that you can purchase as well. Feel free to use and abuse them as you see fit. Thank you very much for your time and attention, boys and girls. I'll see you all bright-eyed and bushy-tailed on the beach next time.